The first step to building wealth is to have a solid emergency fund. Most Americans do not have much in savings, but you are not going to be most Americans. You are going to build wealth, and in this video I am going to teach you how to build a robust emergency fund that will last the rest of your life and that will grow indefinitely. Hello everyone, I am Colin and this is Harness Money, and my mission is to help you build wealth. Go ahead and hit that like button to help me grow this channel and just motivate me to keep making the best videos possible. And now I am so excited to bring you this video. I have got so much to share with you. I'm going to go through all of the steps it takes to build an emergency fund. I am going to tell you where you should put your emergency fund, what assets you should have. Let's go ahead and jump right into this. The very first step to creating your emergency fund is to determine how long do you want your money to last if you ever lost your income. So the first one is time. If you lost your income tomorrow, how long could you last with nothing coming in to your bank account? I would recommend that you make it anywhere from 1 to 2 years. It can be difficult to replace a lost job or a lost business or just lost income. I know from personal experience. And if anything, the last year, 2020, has shown us is that the impossible can happen. So you want to be more prepared than less prepared. If you have a year to 2 years versus just having 3 months or 6 months, it gives you options. You can really hunt and look for what you want, what job that you think you want, rather than just taking what you have to take just to pay the bills. You want to find something that will light you up, that will excite you, but will also pay you what you deserve. So that's the very first thing, is to figure out how long do you want your money to actually last. And then once you have determined that time frame, then you go on to step number 2, which is how much money do you need? And this will be informed by the first one. So if you want to last 1 year with no income, what are those expenses? You want to find out what are the basic expenses that you need to last 1 to 2 years. So you really want to line item your budget. Dig into how much you actually spend per month. There's a lot of things that you are using but may not be necessities. So Netflix, YouTube TV, the gym membership, all those things might not be necessities. You may include them in your 1 to 2 years and make that number bigger, or you might just cut it back to the bare necessities. Your rent, your food bill, your transportation, your utilities, items that you know you absolutely need to survive. That can be part of your 1 to 2 years if you want to have a lower number that you have to build up. If you want the full range of expenses, then you're going to have to build up a larger cash pile. But that is the second step, to figure out how much money do you actually need in this account, because it's important to set a goal. Financial goals have to be concrete. You need something to actually work towards in the future. So that is the second step. The third step on your journey is, where does this money actually go once you have figured out how much you actually need? And this is where I have identified all these different accounts that I believe you should have as part of your emergency fund. And we're going to start with the number one, the most advantaged account that you can get is the HSA, the Health Savings Account. There will come a time where you need money for healthcare. All of us are getting older, no one is getting younger, and there will come a time where you have to go to the doctor, or you get sick, or you need some type of procedure, and that is going to cost money. You don't want to burden people that are depending on you and the ones that you are depending on. You want to have money set aside when the time comes that you need to access those funds, and there is no better account out there for this than the HSA. But I get it. If your employer does not offer an HSA, then you might not be able to contribute to that. If you are on your own, if you're getting it healthcare on your own, then you have this option. But if you have this option, you want to take advantage of it because of taxes. This is the most tax advantaged account. You put money in to that account and that money is deductible from your income, but then you also never have to pay tax on this money when you spend the money on healthcare. So anytime that you need to go to the doctor, you can spend it tax free. You should definitely have some type of health account. Even if you don't have an HSA, earmark money specifically for health, because health is not something that's getting less expensive. Healthcare, same with education, is only getting more expensive with time, so it's important to actually plan for this in the future today. Now, the next account that you should contribute to is going to be your Roth IRA, and the reason that I include this in your emergency fund is because the Roth IRA, you can withdraw any money that you put into this account at any time tax free. You're paying tax on this money when you put money into the account today, so you can withdraw any of the principal in the future tax free. So you can invest in assets, stocks, bonds, real estate, and then withdraw this money at any time in case there's ever an emergency fund. That is capped. Both the HSA and the Roth IRA have limits. Now, these limits will probably go up over time, but they're limited to $3,000 and $6,000. Don't quote me on that. Consult your financial professional for the exact amounts, or just Google it online. But these limits do go up over time as inflation occurs, so keep that in mind as well if you're watching this in the long-term future. Now, the next two are very important because they're probably going to be the most accessed of these four accounts. HSA, Roth IRA, those are going to be for pure emergencies and really last resort. The last two are more available, and that is savings. This is going to be your savings account. Your good old Bank of America, JP Morgan Chase, Wells Fargo. Go open a savings account or choose an online bank out there if you want a better interest rate. But this is where you're going to park cash and just collect interest into the future. That is what a savings account is for. It's just a placeholder for your cash, so you don't store it under the mattress and lose money to inflation. And finally, the last one, the last place that you should put your money is actually, most people do not include this, and I don't know why, because I think it is so very important that businesses use this, wealthy individuals use this, but the average American doesn't really use this as a backup, and that is the line of credit. So the more credit that you have available, the more protected that you will be against bankruptcy or against insolvency. So the more you can increase this number over time, the more cushion you will have. So as your income increases, you want your line of credit to increase as well. It's just sitting there for you in case you ever need it. Now you have to be very careful. You don't want to start tapping into this and going into credit card debt or mortgage debt, something like that. You just want to continue to increase the amount of credit that you have available to you. That can be through a HELOC, a home equity line of credit. That can be through opening a new credit card with a higher line of credit, just calling your credit card and asking them to increase that line of credit, or having a margin account with your stock brokerage where there's credit available in case you ever need to tap that. I really put this in the emergency fund because it's only really to be used in an emergency. Savings, you have that there sitting for you, just waiting for you. A line of credit, you actually only want to use in case it's a dire emergency. But there, that is all of the places that you should put your money when you actually receive it. The next question, so let me write that down for number 3, is going to be where. Number 4, the fourth place, the fourth step in the emergency fund is the assets. What assets should you put into your emergency funds? This is where I probably diverge from most people, because most people say that an emergency fund should be for cash only, just liquid cash. And yes, that is true. You should just have liquid cash in your emergency fund, in your savings account. But I also would include that you have stocks and bonds in your emergency fund, and then bonds. Stocks and bonds. Stocks and bonds are very liquid assets. They're traded on the market. You can easily go when the market is open and sell off any stocks that you have, any ETFs that you have, or index funds, and any bond funds that you may have. Now, you want to keep these in your Roth IRA or just in a taxable brokerage account. It's very liquid to just sell off whatever you have, get that money, and put it right back into your bank account. Especially these days with the invention of Robinhood and Webull, Public and Fidelity, all these online brokerages that are out there these days. They give you the cash instantly when you sell off your assets. Now, the transaction doesn't actually happen for several days in the background, but they go ahead and give you the money up front. That is why I have to give props to the Robinhoods of the world, because not only did they get all of the traditional brokerages to go down to zero in trading fees, but they also are really pushing for innovative ways to invest in the market. And one of them is just giving you cash instantly and then letting the transaction settle in the future. But the reason that I like assets like stocks and bonds is because you're actually getting something for your money. That is where you actually get a return on your money. And really with bonds, you're making money every single month, which I love, income, but it's very stable. US Treasury bonds, there's really nothing more stable than that. Even though it doesn't pay that much, you still are earning something for your income, and the value is not going to fluctuate that much. And you may even increase a little bit over time, but I think it is a great way to grow your income while also maintaining a cushion. These are the assets that you should have in your emergency fund: cash, stocks, bonds. You figure out what strategy works best for you in determining your asset allocation. But now let's get into the fifth step on your journey. Is also extremely important, is your money system. Money system. This is the pay yourself first. This is your direct deposit into your bank, but you want to create a system that happens automatically in the background of your financial life. Whenever money comes into your checking account or whenever you get paid from your employer, money automatically goes to the buckets that it needs to. So rather than having to actually transfer money yourself into your HSA, it automatically goes into that account without you even thinking about it. You don't want to touch your money, because if you touch your money, you're going to be tempted to use that money for something else. Maybe go on a trip, or maybe pay down some of your credit card debt that you've accumulated. But you don't want that to happen. You want to have this cushion build up as quickly as possible. And that is done through systems, through automating your money. Make your money come into your checking account and then go to your HSA, go to your Roth IRA, go to your savings, all those different accounts. Build up your money system and set it and make sure it is in place and that it works in the background and that you don't have to do anything. So it's important that your money goes into your checking account and then it goes over to your Roth IRA. But then once it's in your Roth IRA, it needs to automatically be invested into assets or into stocks, bonds. You need to actually have it set up to where it is automatically invested into your assets. Don't leave it to chance, because the last thing that you want to do is put money into this account and then it not actually be invested in. It's just sitting there. And the last one of all is going to be the most frustrating, and that is time. Now, it took me a while before I built up my emergency fund. I would say it took me over a year to actually build up my emergency fund to a level that I was happy. And the whole time, it was frustrating to see that I knew where I wanted to go, but it was taking longer than I wanted to get there. But I stayed the course. I set up my money system, and then I let time work its magic. That is the secret to money, is leaving your money invested over time. Some of the greatest people that you can study about money, they just built their wealth at an older age because it takes that long to actually accumulate wealth. I'm thinking of Warren Buffett. I'm thinking of Jack Bogle. Those men were well into their later stages of life, later years of life, when they amassed the amazing fortunes that we see that they have today. So let time do its magic and be patient. It will compound over time. It will continue to grow. So this has been a lot of information. We've got our 6 steps that we are going to do to set up our emergency fund. But now is the big question, how does it all grow over time? How do you get to the infinite money loop, the indefinite emergency fund income? And that is going to be through your assets that you have invested into. We talked about HSA, Roth IRA, and the savings. These 3 accounts should all grow over time. With your HSA and your Roth, you are going to invest those assets. I would keep a portion of my money in cash, however much you feel comfortable, even if that's just $1,000 or $500, but I would keep a portion of both of these accounts in cash, but I would invest the rest. Go for a very safe index fund. Go for very safe stocks, like maybe stock in Apple or Microsoft or Walmart or Costco. You can do individual stocks. I am not opposed to that at all. Those are very liquid and easily tradable. There's plenty of shares on the market for the biggest companies in America that you will be totally fine investing in those and just selling off the stock if you ever need to actually access the cash. But make sure you are invested into the market. And if you don't want a higher risk as a index fund or a individual stock, then you can do a bond fund. Your returns on bond funds are going to be lower, but it's safer. It's not going to fluctuate in price. You're going to get paid every single month. And if you invest in a bond fund, you get paid every single month, but it's in your Roth IRA. You're building cash, but you never have to pay the tax on that cash. After you are 59 and a half, you can withdraw that money tax-free. So everything you earn in here will eventually be tax-free, but it will just continue to grow and compound. The more income that you get, the more dividends that you will receive, and it just continues in a vicious cycle, the infinite loop of money. But those are the HSA and the Roth. The last one is the savings. That's probably the least amount of money that you're going to get from your investments. We have covered so much information in this video. Thank you for sticking around, and I have got so much more planned for this upcoming month. I'm so excited for it. Don't forget to hit that like and subscribe button to get the latest videos that I've got coming out for you. And remember, make good money choices. Till next time.